Well, with Broadcom set for its biggest gain since 2020 at the Open, what can we expect from the overall tech sector in 2025? Joining us now with more, we've got Peter Tchir, who is the Academy Securities head of macro strategy. Peter, great to have you here in studio with us.
Awesome to be here.
So what are your expectations given the run-up that we've seen, not just in Mag 7 names, but more broadly within tech and the leadership that's carried over the course of this year?
You know, I think it might be getting carried away with itself a little bit. I'm not going to touch it right now. I think it can continue to go into December, early January. But I do think the friction with China is going to be impacting these businesses, right? Trump is not going to bend over easily on China. He's going to fight with them. It's going to be very oriented around chips, AI, so I think that's a risk. And I think there's been a lot of excitement that we're really going to see a lot of M&A activity and growth. And I'm not sure, I think it's going to be much better than it's been under the Biden administration, but I'm not sure he's going to, let deals happen that much easier.
So then is the market getting a little bit too complacent with the Trump trade? And I guess what does that signal just in terms of maybe some of the risk that investors are overlooking?
Yeah, and it's kind of funny because about a month ago I felt I was trying to talk people off the ledge. Trump's not that bad. A lot of these are just bargaining points. And now everyone seems so comfortable and calm about everything he says. And my experience with him, and I think probably all our experiences, when it gets calm, he likes to up the ante. So I would expect a little bit more noise coming from him. I would say this, it surprised me that he invited Xi to the inauguration. Maybe he's going to try and play nicer with China, but I still suspect ultimately we're going to see a lot of chaos. He likes that. That's how he operates. So the market's become overly complacent right now.
I think the markets are also trying to figure out what a net win looks like even after any tough talks against China or with some of our neighboring countries as well here with Mexico and Canada. What is the net benefit that the markets would ultimately price in? And then if we did not get that, what's the other downside of that?
And I think the hope is that what you see is a well-targeted tariffs on things while maybe providing some subsidies to grow U.S. businesses so that 2 or 3 years down the road, we are producing a lot more domestically, we're seeing that growth. I think that's a lot to ask for, right? You kind of need both. I think tariffs alone without subsidies aren't going to get there, and the subsidies have to be well placed. Just look at the CHIPS Act. It's taken so long to get that money out to companies. So I think we're all a little bit optimistic, like, oh, we're going to turn this on a dime, we're going to have manufacturing here. It takes time, it takes years, so there are going to be stumbling blocks that are hit, and everyone's just a little bit too, oh, this will happen quickly. I don't think it does.
How do you see it influencing, I guess more broadly speaking, just market dynamics?
I think we're going to have to get used to noise, right? There's going to be, everything seems clear sailing. Next day, something else comes out that changes that around. So I think he's going to watch that. And I think we really have to watch Europe in particular, because I think Europe's quite weak. And for the first time we're having trouble with Europe, it's led by Germany. Germany itself is having problems. So they could be a big drag on the global economy.
It used to be that we were starting off these conversations talking about the Fed. We're not doing that right now. Is that more of an indication of where the prioritization from the markets are, where the Fed sits within that prioritization?
Right. I think the Fed's kind of hit this point. They'll cut this week, next week for sure. But after that, I think they're going to go on hold a little bit. I think you've got jobs are okay. We had a uptick in the unemployment rate, but that's really because we had 2 weak household surveys in a row. That tends to correlate back. So I think you're going to have okay employment, and inflation's been sticky. And the other thing, you're going to start seeing inflation data. Companies have been ramping up purchases of chips and everything else ahead of potential tariffs. So I think you're going to see inflation spike up a little bit coming into January, February. That puts the Fed on hold, and everything's going to be, do we get this growth? Is AI story really there? And how do we play it forward?
Yeah, Peter, that is the big question. And we've been talking to so many strategists, analysts here over the last several weeks, obviously. And a lot of the focus has been on some of the outperformance that we could see in 2025. When we talk about Fed narrative, obviously it's changed a little bit, especially in recent days. But there has been so much optimism surrounding financials specifically, a lot of that on the back of the expected rate cuts. Does that at all then change the narrative or the bullish outlook that we have been getting for the sector?
Yeah, and I think what I'm looking for right now is really, I like anything that's involved in the commodity industry. I think commodity prices will remain low, but I think Trump is going to go through very closely all the rules and regulations we put in the last 10 to 20 years when we are the sole superpower and say, do these make sense? So I think we're going to see a lot more extraction of rare earths, critical minerals, and energy domestically, but also more and more refining, right? We have not built a new refinery in this country since the 70s. We've updated them and stuff. I think there's going to be a real push that we have to be able to process and refine these rare earths, critical minerals to remain independent. So you're going to see the companies like the CATs, John Deere, all those, anything involved in infrastructure building, refining, do very well. So that's my favorite sector to play right now because I don't think it's fully priced in at all.
We've heard some lofty expectations for next year, S&P 500 targets ranging from up 10% to up 15%. all these things considered, what do you think is realistic, and are there growing pains to get to that number?
You know, I think the risk is if Europe starts turning itself around and get something, the valuations there are just so much cheaper that you might see money out. Right now, everyone seems to believe the U.S. is the best game in town. Everyone wants to be shifting into the U.S., and there's only so many stocks, so it is going to chase that higher. So I think something has to change in the global narrative, where some other part of the world you start saying, actually, that looks so cheap, and it looks like that's where the growth story. So I think that's the big risk to the U.S. markets, is something turning. So far, it doesn't look like it's happening. Trump's being much more aggressive, proactive, and rate cuts aren't going to cut it in Europe. They need fiscal stimulus.
All right, Peter Tchir, always great to have you. Thanks so much.
Thanks for having me.